Stocks in the consumer discretionary sector include industry leaders like Amazon.com, Home Depot, and Starbucks. For bold trades on this sector in either direction, trade daily 3X leverage ETFs from Direction, WANT for bulls, and PASS for bears. Trade boldly. Daily 3X leverage ETFs from Direction. Before investing, carefully consider a fund's investment objectives, risks, charges, and expenses contained in the prospectus available at directioninvestments.com. Read it carefully.
Are you ready to build, grow, and protect your investments? Welcome to the Index Investing Show, where we give you the tips, tools, and philosophy for reaching your financial goals. And now, your host, inventor of the Portfolio Report Card and author, Ron DeLegge.
Coming up on today's program, I want to share with you 4 battle-proven trading strategies. Of course, we know that no single investment strategy works all the time. And so to have success, investors and traders must adapt to market conditions by using a variety of disciplined tactics. I want to share with you, again, 4 specific strategies on today's show. Also coming up, we'll give you a recap of what's going on in global financial markets and the ETFs tracking them. If you'd like to join us to talk about a particular stock, mutual fund, ETF, or strategy, or just a financial question, the number 844-305-7800. You can also tweet the program at Index Show is where you find me on Twitter. And so let's take a quick gander at what's going on in terms of market performance. We've got total U.S. stock market as tracked by the Schwab U.S. Broad Market ETF ahead just over 18% since the beginning of the year. We've also got international and emerging market stocks ahead about 13 or 14%, between 13 and 14% since the start of the year. So good performance there. And then we've got commodities, another major asset class, up just a nudge over 2%. Ticker symbol USCI tracks that area. And then one final area, global real estate, REET, ahead by almost 15%. So the commonality of all these asset classes, from stocks to bonds to real estate, is they are in positive territory and the performance is strong. Now, in terms of wavering performance, commodities just over the past couple of weeks have begun to kind of slow down in terms of their velocity of bullish performance. We've seen also a retracement in precious metals and gold. A lot of that has to do with the stronger U.S. dollar. So at any rate, that's what's going on in terms of the big picture view. Later on, I want to take a look at the industry sectors that make up the market. We're going to give you an update also on corporate earnings, which right now we're in the middle of reporting season. And I want to give you an update in terms of industry sectors, which industry sectors are performing the best in terms of earnings, and we'll connect the dots and help you understand how that's impacting the actual performance of some of these sector ETFs. So on today's program, I want to focus on some battle-proven trading strategies, and this, of course, can apply really mostly in the context of the way I teach you how to manage and build your own investment portfolio. As you know, philosophically, I use a 3-container approach, which I think can help you to manage your portfolio in a manner that's sane, in a manner that's organized, and in a manner that can help you really understand what each part of your portfolio is doing, and also simplify your overall strategy. So let me just recap for some of our listeners that are newer to the show, just the overall philosophy when it comes to constructing an investment portfolio. So the way I teach it, what I call the DeLegge framework, is you have a core, you have a non-core, and then you have a what we call margin of safety. So those are 3 separate containers. Each of these containers holds investments that are quite different from each other. And that's the whole point. We don't want them to be the same. We want them to act in ways that are different from each other. We want them to be uncorrelated so that this can help, obviously, with your diversification, but also we want to avoid something called over-diversification In other words, having too many pieces within your portfolio that are all doing the same thing. So let's begin with the core. The core is basically a very simple buy and hold portfolio that's diversified across the 5 major asset classes: stocks, bonds, commodities, real estate, and cash. And you're using, in order to obtain that exposure, low-cost index ETFs. That's the core. Very simple. The non-core is the portion of the portfolio where we can be more aggressive, we can be more tactical, we can buy ETFs, for example, that might use leverage. We can go long with leverage, or we can even go short with leverage. We can invest in individual stocks, we can invest in cryptocurrencies, we can invest in private equity, venture capital, we can invest in baseball cards, collectible art, we can invest in vintage automobiles, vintage jewelry. This is all within the context of your non-core investment portfolio, which complements the core. How does it complement the core? Well, it does so by acting in a manner that's quite different from the core. The core is very broad and very diversified, very low cost, very nonsensical. On the other hand, the non-core is very much hands-on. It's very much a portfolio that is strategy-based. And so this is the part of the portfolio we're going to focus on today's show, and 4 strategies within the non-core portfolio that I think I've identified that I think can really help you to manage that portion of your investments. And then the margin of safety is the last container. This portion of your portfolio is strictly reserved for the money, what we call your safe money, the money that you cannot afford to lose. It's your cushion. And as you head towards retirement, as you get to what I call the retirement red zone, that's usually within 5 years before or 5 years after your projected retirement date, you begin to amass a larger margin of safety because, of course, you cannot afford at that stage of your life and career, you cannot afford to get cut in half with market that behaves erratically, with a market that crashes. You just cannot afford to take that or absorb that sort of loss. And so your margin of safety is really, think about it in terms of adding stability to your overall investment portfolio. And so that's the objective of the margin of safety. It's not to try to outperform or beat the market. That's not the objective of the margin of safety. It is strictly to act as a cushion. And so the assets in your margin of safety container are always free from volatility, guaranteed income, and also no possibility of loss. So that's the structure, what we call the DeLegge framework for building an investment portfolio that is architecturally sound. And so on today's program, we're going to talk about more in depth the 4 battle-proven trading strategies. Each of these strategies can be used in your what we call non-core investment portfolio. Now, another way to think about the containers, which I think is quite helpful, and maybe the reason it's quite helpful is because it's just simplified. In terms of your core portfolio, think about that as your serious money. Your non-core portfolio, think about that as your play money. And then your margin of safety, think about that as your safe money. So you've got your serious money, your play money, and your safe money. And so that's again, the DeLegge framework, the 3-container structure that composes an investment portfolio. Each one of those containers behaves quite differently from the next. They all complement each other. And that's one of the things that I think can be quite helpful to all of you. By the way, this is something that I teach in my online class. You can go to indexshow.com, and I've got a series of videos. You can enroll in that class, and it's called Build, Grow, and Protect Your Money, a step-by-step guide. And I go more into depth about each one of these containers and specifically the types of ETFs that fit into each of these groups. So it's almost time for us to take a quick break. Before we do, I want to remind you that we're here if you'd like to join us, 844-305-7800. At Index Show is where you find me on Twitter. And when we come back, we'll give you an update on what's happening in terms of industry sectors and performance.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
On our Twitter feed at Index Show, Paul Krugman, the famed economist, says he expects to see a global recession later this year. He warns we do not have an effective response. Well, here's my response to that. Full disclosure, economists like Paul Krugman have accurately predicted 9 out of the past 5 recessions. Trendonomics' response to that is astrologists have a better track record. True that. Here's another thing that I have on the Twitter feed. This is the number one reason Americans are so stressed out. That's from Market Watch. And you might want to guess, you probably guess what that is. It's money. Issues related to money and finance. That's the number one thing stressing out Americans. And there's a lot of things in that article that I think are good, studies that confirm that. But the point that I want to make, I think one of the biggest things that people need to understand, especially those that are in the accumulation phase of their investment plan. In other words, you're working right now, you're trying to save some money for a later date in the future. All of us will at some point need to retire. Whether we want to or not, we will need to hang up the cleats and retire. Whether we're forced into retirement or whether we are just sick of working and we don't want to work anymore and we're going to retire. All of us, if we live long enough, will be forced to retire. And so my point is this regarding stress. Not paying yourself before everybody else is really, really bad for your finances, and it's bad for your stress level. And you know what? It's also bad for how you feel about yourself. From a self-worth perspective, it's pretty bad. And so what I'm trying to help you understand from a psychological perspective is the need from a self-worth perspective, no matter how many bills you have, to earmark at least some money for saving and investment. And before you spend and then decide, well, I'll save what's left over after I spend, why not save first and then whatever's left over spend? See, having a counterintuitive approach like that. But again, paying yourself first, we've got to be committed. You've got to be committed to that. You've got to believe in yourself. You've got to believe that you're worth it. Because the people that don't pay themselves first, the people that are constantly paying everyone else first, have very low self-esteem. That's what I have found over the years. And so we want to help lift up your self-esteem, lift up your self-worth by paying yourself first. And doing that on a regular basis, a consistent basis, a disciplined basis. And of course, there's many things that can help you with that, like dollar cost averaging. But you've got to commit to yourself. I mean, I can't do that for you. I can try to convince you that you're worth it. But if you really don't believe it in your own mind, that you're worth saving for and investing for, you're worth setting aside that money for yourself. If you don't believe that, well then you've got to work on your self-esteem and make that a priority, because if not, you will be in a situation where many Americans find themselves just years away from retirement with very, very little in retirement savings. So 844-305-7800 is the number if you'd like to join us. We're here. At Index Show is my Twitter handle. You can read some of my comments and, again, some of the links that I'm talking about, again, on our Twitter feed at Index Show. If you missed last week's program, we talked about the surprising benefits of leverage. I know leverage is something that is used in institutional circles. You know, big-time money managers, hedge fund managers, they quite often use leverage. The idea there is to try to magnify investment performance. And so leverage obviously is a two-way street, right? It can work for you if things are going very well. Of course, the reverse of that is true. If you make bad trades, if you make bad calls, leverage can really come back to bite you. But there are some surprising benefits of leverage used in the proper context. And last week's show, if you missed it, you can listen to it on our archive at indexshow.com. We archive every single broadcast that we do, and you can listen to that episode, The Surprising Benefits of Leverage. Before that, we have another episode about an $8 million lesson in perseverance. And that particular episode is also available along with all the others. You can listen to our broadcast our podcast. It's available on Spotify, iTunes, Google Play, and fine platforms everywhere. So let's continue our conversation about 4 battle-proven trading strategies. I want to focus on the first one. And by the way, I should remind you, and I said this at the outset, but it's worth saying again, that no single investment strategy works all the time. Now, I know, for example, Warren Buffett, his value discipline has been glorified as this is the one that works all the time. This is the one that's proven. Well, let me just say that as good as value investing has been for people like Warren Buffett over the years, there are a number of value investors that have had lesser levels of success, and they have not done as well as Warren Buffett. So Warren Buffett's the exception, but the point is that even with something as wonderful as value investing and something that makes sense intellectually, there are periods of time where it simply is out of favor, and it simply does not work as a strategy from a performance perspective. I think back to the late 90s when everything was mostly growth-orientated, and those were the types of investments that performed the best, were the growth investments, small cap growth, large cap growth, mid cap growth, and it was the value investing that lagged. So let's talk about that for a second. And this is the first battle-proven strategy: is momentum trades. So what are momentum trades? So you're trying to focus on owning ETFs in markets that are good performers, areas where they're rising in value and benefiting from bullish market sentiment. Now, often these types of trades are typically executed at or near a fund's 52-week high. Compared to other strategies, momentum trades can often blossom much faster. And so what you're trying to do is you're trying to ride the inertia. You're trying to ride the momentum in a certain direction. Now, a couple of examples of what we might call momentum trades so far this year in terms of what is performing strongly. Take a look at the rebound we've seen, for example, in the Chinese market in terms of Chinese stocks. Now, last year was a bear market for Chinese stocks. They were not good performers. This year is quite the opposite. Chinese stocks have been one of the best performing regions across the globe. And so ticker symbol CHAU, which is a definite momentum trade, that's the direction daily CSI 300 China A share bull 2X shares. So it aims for double daily performance to China's index, that CSI 300, an index of Chinese stocks A shares, is up almost 70% since the start of the year. And so this is a perfect example of what we would call a momentum trade. And again, it's just one of 4 battle-proven strategies. I'm going to tell you about the other 3 when we come back. If you'd like to join us, 844-305-7800 is the number. You can also tweet us at Index Show, and we'll also take a look at what's going on in terms of industry sector performance and earnings. Which sectors have the strongest earnings?
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
Do you have 10 years or less to go before retiring? Do you have minimal retirement savings? Have you ignored saving for retirement because of financial setbacks or other obligations? Do you feel like your hopes of having a comfortable retirement are doomed? If you answered yes to any of these questions, you need a retirement rescue plan, and Ron DeLegge's online class is the answer. Go to indexshow.com and click on the Enroll button to get started. Ron's retirement rescue plan will teach you how to salvage your retirement by accelerating growth, cutting financial risk, and maximizing your savings. Go to indexshow.com and click on the Enroll button to get started. At some point, everyone will reach the age when they must retire. But living a stress-free retirement won't happen by accident. Take Ron DeLegge's online class titled A Rescue Plan for Retirement Late Savers. Get started today. Go to indexshow.com and click on the Enroll button.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
All right, 4 battle-proven trading strategies. We talked about momentum. We're focusing on areas of the market that are strong, that are good performers, that have bullish market sentiment, that are rising. We gave an example of CHAU, that's the ticker symbol, for the China A-shares 2X ETF from Direction. And that's a perfect example right now of a momentum trade where the momentum is bullish. The momentum is upward. And so something that's quite different from the momentum strategy in terms of what the overall philosophy is what we call the contrarian battle-proven strategy, which is at the opposite spectrum of momentum. Because with contrarian trades, what you're doing is you're focusing on buying ETFs in markets that are out of favor, markets that are poor performers, markets that are deeply undervalued. Often these types of trades are executed at or near a fund's 52-week low. So compared to other investing strategies, a contrarian trade can take longer to blossom, but the prospect of gains can be quite significant. So again, just comparing the contrarian strategy versus momentum. Remember, momentum, you're often buying an ETF at or near its 52-week high. The opposite is true for the contrarian strategy, which is you're buying these funds at or near their 52-week low. So the opposite spectrums completely, opposite philosophies. The contrarian trades compared to, let's say, momentum can take much longer to blossom, but often the prospective gains, if you're patient enough, can be quite significant. And so that, some of the great contrarians, David Dreaman, a value investor, most of the contrarians that I know tend to be focused on the value in the value camp, value investors. They combine that, they're looking for beaten up, out of favor investments, areas of the market that are being ignored or hated, and they buy when others are selling. And so it takes a lot of stamina, and it also takes a lot of courage to be a contrarian. And so what examples can I think of in terms of contrarian investments at this particular stage? Well, I would say just from an asset class perspective, when we take a look at the major asset classes, stocks, bonds, commodities, real estate, I would say the major asset classes, commodities is probably, in my view, the one that sticks out as a contrarian trade. This is a particular asset class that, compared to the others over the past several years, really since the financial crisis, has consistently underperformed. It's consistently disappointed. And so that particular group would certainly qualify, in my view, my estimation, as a contrarian trade. Commodities, something like ticker symbol USCI, DBC. These are some of the ticker symbols that track broadly diversified commodities, which I think have a lot of potential from a contrarian perspective to rise. So that's momentum and contrarian trading, those two strategies contrasted. Coming up in the next segment, we'll take a look at 2 other trading strategies to add to this particular arsenal this arsenal of 4 battle-proven trading strategies. 844-305-7800 is the number. You're listening to the Index Investing Show. I'm your host, Ron DeLegge. We're here every week at this same hour. If you have not had a chance to go to our site, indexshow.com, you can listen to our archived broadcasts, listen to our show right there. You can also listen via iTunes, Spotify, Google Play, YouTube. You can find us. Also, my online classes. You can click on the link right there and be linked over to some of my online classes. I've got 4 classes each, and you can find something there that will help you to increase your knowledge and increase your confidence level in your ability to manage your own investments. Now, something else I want to mention is the May issue of ETF Guide Premium has just been released. And there's a lot of good stuff in there. Now, a couple of things that I want to point your attention to. We do the monthly income trade, which happens every single month. We simply use this strategy of selling covered calls on an all ETF portfolio. And the income ETF portfolio has been in existence since February of 2012. Now, mind you, it's not a real portfolio. It's a hypothetical portfolio, but we've been tracking since February of 2012 every single monthly income trade. And so far, since then, the income mix portfolio has generated just over $51,000 of monthly income. If we average that out over 84 months, it comes out to about just over $611 per month. Now, it's a hypothetical $128,000 portfolio. And again, the strategy is just to sell covered calls every single month in order to generate income. So the latest trade for May, and remember with these income trades, even though it's still April, we do the income trade always 1 month in advance because we target the third Friday of every single month, 1 month into the future. That's how your income trades work with selling covered calls. We're allowing someone else in the market the right, not the obligation, but the right to buy our underlying ETF shares at a certain price that we're willing to accept. And usually that price is higher than what we've bought the ETF at. And so in exchange for that right to buy that ETF from us at a higher price, we are accepting what's called premium or income. They're paying us money for that right. And so that's where we generate the income. And so for the month of May, we generated $865 in monthly income from our latest May income trade. And so this, again, is another thing, especially for the non-core portion of your portfolio. If you're looking to generate income over and beyond what you get with just dividends from dividend-paying stocks, or income that you're getting from bonds, this is another great income strategy, especially for you retirees. That's the focus, right? You want to have more income. So selling covered calls, I think, is a quite smart and quite strong income generating strategy that you should add to your arsenal. So you can learn more about that at etfguide.com. Click on the premium newsletter, and you can become a subscriber. 844-305-7800 is the number. You're listening to the Index Investing Show. In terms of earnings, which industry sectors have the best earnings performance for the first quarter? Now, remember, corporate earnings here for S&P 500 companies, even though we're in the second quarter, right? They're reporting first quarter earnings, right? It's too early to report second quarter earnings because second quarter's not over yet. So they're doing the first quarter earnings, and so far, if we look at this from a big picture perspective, pretty darn good earnings report card. We've got 77% of companies within the S&P 500, the ones that have reported thus far, beating actual earnings per share estimates. So that's pretty strong. The industry sectors that are doing the best in terms of earnings are technology. You've got 96% of technology companies thus far that have reported that are above earnings per share estimates. So technology very strong. Consumer discretionary. You've got 83% of the companies beating earnings per share estimates, and then consumer staples. Those are the top three industry sectors thus far in terms of earnings beats. And we're going to tell you what's going on in terms of link that up with the specific ETF ticker symbols and the performance, because I've got some amazing stats to share with you on that front. So stay tuned for that. 844-305-7800 is the number. More when we return. I'm Ron DeLegge. This is the Index Investing Show.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
On next week's program, I want to talk about hidden pitfalls of zero-fee ETFs. I know that they've been celebrated in pop media circles, financial windfall for retail investors, right? ETFs without fees. Wow, you can't lose. It's wonderful. But compared to what other choices are out there, I want to just compare this for you on next week's show and give you some real perspective that I think challenges these consensus opinions and consensus views that zero-fee ETFs are the absolute best and absolute lowest cost choice for investors. So stay tuned for next week's program. We're going to talk about the hidden pitfalls of zero-fee ETFs. @Index Show is my Twitter handle. You can find us also on the web, indexshow.com. And if you'd like to email me with a question, if you'd like to get a portfolio report card, ron@indexshow.com. Reach out to me and we can talk. Now, I want to discuss, as we wrap up today's program, two final battle-proven trading strategies. The first one is income trades, which are focused on buying ETFs in markets that offer high dividends. It also involves strategies like selling covered calls, selling put options on ETFs to generate immediate income beyond the fund's dividend. Now, unlike other strategies, income trades do not rely on directional moves, up or down, in an ETF in order to realize gains. So the whole point of income, right, you're focusing not so much on a directional trade, making a capital gain or profit. Your focus is, how can I extract the maximum amount of income from this particular strategy or this particular ETF? And so we just gave you an example in the last segment. We discussed the monthly income trades that we do at etfguide.com in the premium newsletter, and that is a perfect example of income trades. Another example of an income trade would be something like ticker symbol XLRE or XLU, two ETFs focused on industry sector groups with higher dividend yields than the broader market. So XLRE follows the real estate stocks or REITs within the S&P 500, and then XLU follows utilities. Again, both of those sectors are what we call dividend-oriented sectors where you can get a lot better income in terms of yield compared to the broader market. So that is your income trade strategy. And then the final battle-proven strategy is defensive trades, which are focused on buying ETFs and other investments that offer capital protection when market conditions are deteriorating. This type of trade usually performs the best when market sentiment is fearful and bearish. Defensive trades can also be executed when market conditions are overly optimistic. But of course, if you do that, your defensive trades may require more time to develop. And so defensive trades, an example of a defensive trade, well, right now markets, what's the sentiment in the overall global stock market? Well, right now it's bullish. It's positive. Despite all the negativity that you hear in the daily news, especially the political rhetoric, as negative as that may be, we've got to separate that the actual market is doing, because market performance has been quite strong, it's been quite bullish. And so if you're going to be a defensive trader, In many ways, you're contrarian, especially if you're buying defensive trades when markets are rising. So an example of a defensive trade would be something like ticker symbol SPDN. That's S, P as in Paul, D as in David, N as in Nancy. That's the Direction Daily S&P 500 Bear 1X shares, which aims for 100% daily opposite exposure to the S&P 500. So if the S&P 500 on any given day falls by, let's say, 1% in value, then the goal of SPDN is to be up by 1%. So it delivers 100% opposite performance to the S&P 500. It's a bearish ETF, and you could say, especially in a market, that climate that's falling, it would be considered a defensive trade. And so that it wraps up the 4 battle-proven trading strategies from the beginning to the end. Let's start with the beginning. We started with momentum trades. After momentum trades, we've got contrarian trades. Then we've got income trades. And then we've got defensive trades. And so that's the framework that I call the 4 battle-proven trading strategies. I like this framework because you can easily organize your ETF investments and trades into each one of these categories, whether it's momentum or contrarian or income or defensive. It's just a nice way to think about your overall goal and why you own that investment or that ETF. Is it because you're trying to be defensive? Is it trying to generate more income in the portfolio? Maybe you're trying to make fast hits. You're trying to do a momentum trade. Maybe you're willing to wait for an investment that is unloved and it's out of favor, and you're going to buy it while it's hated, and you're going to wait for it to rebound. That's the contrarian trade. So each one of these I like because it's different from the next, and it's just a really, really helpful way to organize your trades. And it's something that we do at etfguy.com in terms of the premium newsletter. This is the framework that we use in order to really wrap our arms around why we're buying a certain ETF, and we fit it into one of these 4 categories so that it helps us to understand what we're attempting to do. Now, as we begin to wrap up, I want to mention a couple of more ETFs in terms of industry sector performance and link these up. We talked about the technology sector, where you've got 96% of the companies that have reported so far in the S&P 500 have beaten or exceeded their earnings per share estimate. That's good. Ticker symbol TECL is a perfect example of a momentum trade, which has gained very nicely in 2019. It's ahead by almost 95%. TECL aims for triple daily performance to technology stocks. That's a top performer. Also, SOXL, which focuses on just semiconductor stocks, ahead by over 122% since the start of the year. Now, we have had a little bit of a pullback in SOXL. It was ahead by as much as 140%, so it's really dropped off over the past week or so. We had some negative results out of Intel, so I think that's been weighing on the semiconductors. But the performance is still bullish, and it's still upward. A couple of other industry sectors, communications, XLC, and then the leverage version, ticker symbol TAWK, ahead by just over 50%. And in that particular group, we saw very good results from both Facebook and Twitter. Both of these stocks are part of that communication services sector, and both of those stocks rising sharply this past week and lifting that group. Also, another sector, this is a consumer-based sector, and that's consumer discretionary, ticker symbol WANT, WANT. And that particular group, which includes Amazon.com, has been a great performer, up over 78% since the start of the year. WANT, W-A-N-T, aims for triple daily performance to consumer discretionary stocks, and that continues to be a very, very strong performing area. And then from just a broader perspective, if we take a look at the broader S&P 500, which is also in an uptrend, another example of a momentum trade, SPXL, which aims for triple daily performance to the S&P 500, ahead by just over 58%. So those are your your what we might call non-core ETFs for the non-core portfolio, and if they're complementing your core, you've done well thus far in 2019. Well, that does it for another episode of the Index Investing Show. Join us again next week, and we'll be here. And until then, may the market indexes be with you.
Thank you for listening to the Index Investing Show with Ron DeLegge. Connect with us on the web at indexshow.com. And be sure to subscribe to our podcast at iTunes, Spotify, or Google Play.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.